Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 30 minutes on Options Guy TV. We're going to definitely go 30 minutes today. I got quite a few trades that I want to work through. Let's start by let's run right to the SPX because I always do that. I talk a little bit too long, and every minute matters in the S&P 500 index. But we had a very weird thing happen. We had the IWM set a new high, the SPX set a new high, and the NASDAQ set a new high last week. It's been years and years and years since that has happened. I think things are starting to roll over. We're getting into September and October, and I'm going to lean into those trades. The market indicated down this morning in the SPX. We still got the NASDAQ down a little bit. NASDAQ right now, that's actually made its way to positivity too. So we got the SPX up. We got the NASDAQ up. We got the Russell 2000 down a smidge. And we got the Dow 30 down. But who cares about that, right? So today I want to lean. I'm going to go bearish. I can't fathom that we're going to end up today. I just the feeling of the market. And I mean, we do have Fed speak. We have a PCE number. We have Costco earnings. We got Micron earnings. TikTok deal happening. Still just a plethora of news all around. But ever since the Fed meeting, they cut the quarter point, which was highly anticipated. For some reason, though, the marketplace really liked that cut, or I don't know, the announcement of the obvious. Nothing beyond really happened besides that. So with that said, the markets, I just feel like they're frothy. And so I'm going to look at two different trades. I'm going to start with the SPX. Let's do a 0 DTE SPX butterfly. So let's run to the what if calculator to start. Yep, we're showing it right now. And we're going to, I'm going to go wider because I want to change some things up. I don't want to just be boring. And look, we were looking at $3 butterflies between $3 and $3.50 on a 0 DTE basis, doing 10 points wide. I'm going to go, I think I got to set up for 15 points wide. We're going to pay $5 and let me see here. We're going 20 points wide and then 10 points. That's it. 540. Okay. So we're going to pay $5.40 for this trade. And VIX is at 1587. SPX, we're sending that to the ticket. Trading right here. Let's go SPX. We're going to look at a gold trade too today, but let's get this trade on. All right, lean bearish. We're going to go 20 points wide. We're going to spend a little bit more money. Normally we'd be about $3.30 for the trade. We're going to pay $5.40 for the trade. We're going from $6,695 down 20 points to $6,675. And then we're going to stop short. We're going to only go 10 points on the downside. We're going to look at the $6,650. 6,000. That's a fun one to say. $6,665 put on the downside. So we stop short here. This is 20 points wide. This is 10 points wide. We're paying $5.40 for it. And boom, we send that trade down to the trading floor. $540 is going to be our net risk to the trade. Our upside, if the market does go down below that level, is going to be $540. So it's going to be around $450. Obviously, as usual, when we go to the what if calculator, it grabs whatever the price is at that second and it puts it in on the trade. And I do need to let you know that this right now, 675. Yeah, this is looking solid on the SPX. It looks like they've made a couple of tweaks to the derived value, and we are now at I'm showing on my real-time quote 6,675, and this is 6,676. 75.80. Yeah, so it's close. So good. That's good to know. Downside now, I'm going against the grain. What our rule I don't know if it was a rule. We just always, if the market was going down, we went down with our puts. And if the market was going up, we went up with our puts. I think I'm going to lean to the bear side today as we head into the close. I just think things are frothy, and I think they need to come down a little bit. Google, a little bit overdone too. That stock is down a tad. Netflix is showing down. Yep. So NVIDIA down. Yeah, I can't fathom the market can sustain even the small gain that it has today. Right now, up about 0.20% today. So this is our trade, and I like it. I like this one today. I like this one. All right. Next trade. Let's go and do the opposite side of things. Gold set a new high. Market is to the upside. We looked at a gold trade on Friday, but we didn't pull the trigger. We were trying to do a 0 DTE gold trade, and there's just not enough juice, not enough premium in that. Ball's trading around 15%, but we got some volatility, some predictability. We're above the 341 level, so we're setting another new high in gold. And this goes along with the frothiness of the marketplace. People are, I feel like, a little bit nervous. October isn't that far away. People are running to gold as a safe haven. And let's do a trade in gold. Let's go out 1 week. And well, we'll go to Friday, not 1 week. We're going to go to the 28th. Is where we're at. 26th would be Friday. 26th. My eyes just aren't what they used to be. Okay, so we're looking at the 26th here, and I want to get bullish. I want to flip the script. We were bearish. We did well on our bearish butterfly. I think I actually already have it in the what if calculator. So we're going to get bullish this time around. We need to grab this and send it to the ticket. All right. 330. Okay, so we are going to go 6 points, and then we're going to stop short 2 points. So instead of doing the standard butterfly where you're 6 points wide here and 6 points wide here, we're going to increase our cost a little bit, and we're going to stop short on our short spread. We're only going to go 2 points wide on that short spread, and that will increase the cost of our butterfly, but also make us profitable above the 345 level. Almost exactly. Well, that makes sense because that's where the strike is at. Our break even is what I'm talking about, what I'm looking at. Our break even is going to be right here, right at 340, which is this strike, 337 plus the net debit paid. So our break even, if you do the math based off of our price that we're looking to get, $3.33, it would be $340.33. That's where we should cross our break even. So we want that underlying to finish above that level at expiration. Right now, we have the market at 343.03. All right. So hoping the market stays above this new high and that momentum continues. See the markets going down, see the gold trade going up. And ideally, I guess you could do both of these trades, but they're both kind of leaning the same direction in that you are taking gold as a safe haven because you think markets are going to go down. So either you get both scenarios where gold does stay above the new 52-week high or all-time high, and you do get the markets go down, or you could just do one. You can lean on one side of things. If I were to lean on one, I think I'm a little bit more bearish on the market in general, as opposed to being bullish on gold. Gold has set that new high. It needs to maintain it. It needs to stay above 341. If it does that, then there's a good sign that this bullish momentum, or maybe the next leg up on gold, path of least resistance would be higher on that trade. All right, so on UNH, we did do a butterfly last week, so we got to look at that. Let's send that one to the trade ticket. And right now it's up a bit. Here's where our trade is at. 398. Okay, we put it on for 320. We're up 80 cents on the trade. It's trading for $4 right now. Let's Go to trading, and let's look at UNH. Oh wow, nice little pop today. It's up more. It just popped about $1 since the show began. 342.12, $342.12, up $5.83 on the day. Maybe that is what's kind of keeping the SPX up and rolling. I don't know. I'm not quite sure why the SPX is still staying to the positive. I don't know what's driving it northward at this moment. Maybe the TikTok deal that's going on, maybe that's helping things. But UNH at 342.02, I still like the stock. I like the chart in particular. I think that gap needs to get filled on UNH. So this is the gap that I'm talking about from here to here. So let's zoom in this area. So 360, like to get bullish, especially if we get to 3.6, let's call it 364. Yeah, that would be a nice range, right? If we could get to 364, close above that, then we're looking all the way over here to the next stopping point at the bottom of this one of 377. So we're within the channel, a little bit of period of consolidation, still above the 20-day and the 50-day. And I like this move today on a kind of a shaky market to see it in this range. Yep, 341 had some down candles. Yeah, I like it right here. I like the trade. I think obviously you got the bullish momentum that's coming. Nice to get above this channel today, 345 or higher. And yeah, that's where our trade's at. So we got 4 days remaining. By Wednesday, time decay is going to really start kicking in. From Wednesday to Thursday, the huge rate of time decay, if we stay up above this range, 390 is what we paid for it, the maximum that it can trade for. Yeah, what is that upside? Let's go look at the what if calculator. So right here, 135 is what it's saying if you paid $4. So we're looking at about around $2.50 on the upside. So I think it's trading for $5, right? Is that the difference? 340, so 2.5, and then 7 and 8. Yep, $5. So the maximum it could trade for is $5. We put it on for $3.20. That means that our max upside, if it's in this range, is going to be around 180. All right, not a bad trade. Still like it. Keep that trade on. And then if we drift a little higher, see, this is where the last trade is at. So if we start coming back down and we go and hit this area in the short term, we got our out period, right in this area. We need another day's worth of time decay. This is as of today, so the green line would be a little bit higher, but we want the market to stay up here and then eventually start drifting back towards our middle strike. That would be our ideal situation on the UNH trade. Am I showing the 926? Yeah, I am. For UNH, right, Anthony? I'm pretty sure that's right. Happy New Week on UNH. Gold 920. Yep, I would do 926 on gold too, if that's what the question was around. Go ahead and toss out Anthony's question. 926. Those are the expirations that I'm looking to deal with on both of these underlines. As far as the SPX trade is concerned, oh, that's where it is at. The XPX trade should be today. Send a ticket. 560. All right, we want to change that one up. Okay, let's do. I hope this doesn't make it too expensive. We want 922. That jumped too much on us. $11 on the 20-point wide. All right, let's make it 15. Thank you, Anthony. 690. Let's go 15. I knew that was too good to be true. 6. Well, I didn't, but I did. And then this would be 10. 660. This needs to come back down. So that's 5 and that's 15. $8. All right, we'll make that the paper trade. And we just lost 15 minutes on it. Okay, this will be the official paper trade. And we'll look at this one on Wednesday. 175 is our upside. Zoom in on this. Yeah, so we're right here. 922 is where the market is at. Want to go to 6675 is where we'd like the market to end up at. 6679 right now. Want to lean 7.5 and then go beyond. Paying $8.10 for it. If it goes all the way down on the downside, this would be worth 10. So you're looking at $2.90. This is saying 175. $2.90 on the upside. The maximum that I could trade for is $20. Means you would be up around $1,200 on the upside per 1x2x1 butterfly. Our max risk is going to be $8. If the market goes up above the 669 strike, 6,690 strike. Thank you. Yep. Yeah, that was a good trade for 5. I actually wouldn't mind doing that for the week. I mean, that's not a bad. The trade that we had on, or that I first looked at here for 590. I'm going to send that one to a ticket. Going to the end of the week, I expect this week to be bearish. We got the PCE number on Friday. Got Costco earnings. There's a lot of consumer sentiment information. A lot of Fed governors that are going to be speaking. I don't mind this trade at all. Just doing a 1 week butterfly. FYI. But that was not my intention. My intention was to do a 1 day butterfly. And this is the 1 day butterfly. 835. All right. Any other questions? Well, Anthony, go ahead and put Anthony's last comment up. Yeah, I don't mind that trade. I don't mind that trade this week at all. The only thing that is a little bit befuddling is that the markets are up at this moment. I don't really understand why. Just flying through charts, right? You got Google getting a little frothy. Look at that parabolic move. Apple, actually, I see that pop across the chart. Apple getting frothy, bumping up against an all-time high there. Amazon is actually down, or not as strong. Amazon's not as strong. And then Netflix giving away a little bit today. Giving back a little bit on the downside, down 12 or about 1%. I just Microsoft down 285. I don't understand exactly. Oh, and then I want to do the Russell trade too, by the way. I want to show you the Russell trade. Haven't talked about Russell in a real long time. But like I mentioned at the top of the show, well, I can't do RUT. I got to do IWM. IWM. But it may be time to duck IWM again. Let's go back 1,500 days. So if you remember on Options Guy TV, we did long straddles. We bought one down here. We bought one up here. And we traded this channel fairly successfully. I'm trying to think if there was really, and Obviously, on Options Guy TV, we're only trading 3 days a week. But even doing that, this was a successful trade in that, look at the range on this, from 163 all the way up to 200. So you're looking at about a 40-point channel, and these are about 1 month periods. Okay. Finally break out of that channel here. Then the chop, hard to judge exactly what's going on. Inflation, tariffs, people get worried, and then parabolic move to the upside, setting an all-time high just recently. And let's zoom in over here. And so what do we do next? What do we do next in IWM? I don't mind getting bearish. If you want to, just once again, getting into September and October, Friday we have PCE coming out. We have, I think that, I mean, that's the main thing that's happening. Just Fed speak too, but man, that's frothy. So I don't mind getting bearish, but I also don't mind doing our straddle. And my opinion on IWM, and I don't like long straddles. It's not my favorite trade to do, but I've always thought in IWM that when you're looking at even this trade going out to September, like vol's 19%. I always feel that the IWM vol is always underappreciated. IWM, I mean, you can have companies that are in the index go bankrupt. You're talking about small cap companies. I mean, they could go bankrupt in a month, and you got more volatility. I mean, sometimes super micro used to be in IWM for a long time. I don't even know if they got rid of it, but it was no longer a small cap, but they kept it in there for a while, longer than they should. But the long straddle is always around $12, 30 days out. Let's see where we're at. 30 days out. Come on, one more here. There we go. 32 October. Let's go 39. October 31st. That gets us through the whole month of October. Vol's at 20%, so it is anticipating that. So you got to pay up a little bit for it. Market's at 243. But now this is a highly speculative trade, so don't. That's 13. Okay. I thought it would be closer to 12, but we're at 39 days, not at 30. 25 might be closer to 12. 243 leaning a little bit bullish here. I would want to flip it and go bearish. Right. So I would want the put to be a little bit more in the money. I would go to the 244 or the 245. Let's go 244. Let's see where that's at. I would rather have the put in the money than the call. 1320, $1,325. If you think that IWM can move 10 points over the next 39 days, ideally you'd want it to happen within the next 15 days. If we get to move to the downside, implied volatility should come up, which would also be solid. And if you look at the chart, a 10-point move is nothing, right? 245 here. It was at 235 just a few days ago. When was this? 235 right here. 1, 2, 3, 4, 5, 6. About 10 sessions ago. Go all the way down to the 20-day moving average. If you go to the 50-day moving average, last time we touched that was right here at 2. Like this was an important point, right? Market, yeah, that's very telling right here. Let's zoom back in on that area. Make it stand out a little bit more. This is actually called a golden cross, and this is a more important one in my mind, in that this is a 200-day moving average and this is a 50-day moving average. It came right down to that 50-day and then bounced, And we are a little bit now, we're quite a bit extended from the 200-day, but we have the ducks in a row, which is a good thing on momentum to the upside. But you could see if you pull back to the 50-day moving average, you're looking at 228 from here, which would obviously make this trade profitable. And then the 200-day is all the way down around 216. So I like the straddle, but if I'm going to lean any direction, I'm going to look at a put spread. We'll keep it in that same range. And here's a different alternative trade. I'm going to keep them both. We got that in the what if calculator, right? Well, let's add it to the what if calculator, and we're going to watch both of these trades. Because right now we're at a precipice. Are we going to break out to all-time highs in IWM? Do tariffs, start kicking in a little bit more than we think? I still feel like we don't have the whole tariff story at this point in time. Anthony says bearish. Go ahead and toss that up there. And I agree. I do think that this is a fair price for a 39-day straddle. I think vols being with the all-time high hitting in IWM, markets are frothy, implied volatilities are low. I don't mind buying this long straddle. Okay. Now, if you want to, and in a weird way, if you want to be a little bit more speculative, let's just get bearish. Let's just lean one way. And I like this trade too. We got some decent volatility skew to the downside. So a bear put spread is going to be nice in that you're buying 20 vol, selling 22 or 23 vol. So that's got a decent amount of skew to the downside. So you're going to get a decent risk reward profile. Okay, let's go 245. Let's go back and look at the chart. 235 is right here. Where did we, all the way down here was 215. That is definitely going to be a area of resistance. And it kind of happened just from looking at this. There's a lot of noise right in this area. This candle came down and hit the 20-day here. And then this is a bearish cross, right? When the 50-day crossed over the 200-day here, and that actually worked out pretty well too, didn't it? At that cross, because we right at that precipice here. So it seems to be which IWM isn't very good usually with technicals. 235 is here. I think I'm going to go all the way down to the 230s. Let's see what we can get for the 230s going out 39 days. Yeah, I think that's the trade. I like that range just off of the chart. Okay, and this is $7 if we go a couple of bucks in the money. Do this one. Delta's 48. Here we go. 245. Sell the 230s. 39 days. Okay, so, and here's the way that I trade this. I'm going to send this to the what if calculator. The fact that we are wide enough on this trade, if the market, if we get halfway through and let's say the market gets halfway there, we can take some profits on the call option because we've got $2 in it. We got $2 in that call option going out 39 days, $2.20. The market does go this direction. We can always roll this put up. Say this starts trading for 110. We could roll up to the 235 or even to the 240 if we want to. So there's one way that you can do this where if it does break out to the upside, kind of like we're talking about with the long straddle, if it breaks out to the upside, you could buy this back and roll it up and bring in some more credit, offset some more of this risk. Now, on the way down, if the market goes down, well, you still got time decay on your side. Let's say half the time goes by and you only go half the distance. You still might be able to adjust this short side of your trade based off of the amount of time to get, and maybe even take that and still roll it if you would like. Ideally, the market just goes down and you get to this level. Now, there's going to be some premium in it because it's a fairly expensive underlying. And you see that the profit and loss graph right now is saying that if we get there in the short term, we don't get rewarded as quick. We want ideally to get there about the 20th day of this trade. We're going out 39 days overall. But I like this. I like this trade. I like both of these. As far as the markets are concerned, you got seasonality going on. The Fed already spoke. We've got 3 markets that hit all-time highs. We got the VIX still hanging out around 15. A lot of complacency in the marketplace. I don't think it would take much to get this momentum moving to the downside. So in IWM, if you do the long straddle and you're going out 39 days, here's the biggest thing about the long straddle is it's hard to lose the maximum. To lose the maximum on the long straddle, the market has to finish at that strike price at expiration. I don't like strangles because of that. I'd rather do a long straddle. You got to pay up for it, but you also realize that you're probably not going to lose the entire investment. I mean, that would take a small miracle for that to happen, that the stock would stop right at the short strike, right at expiration. So, and I always like to leg out of the long straddles too. I've done a lot of them where I've made money on the call side and on the put side. So that's where I'm at. These are the trades. Like I said, it was going to be a little bit of a long show today. Any other questions? If not, come back on Wednesday. It's going to be an interesting day and an interesting week in the markets. Thanks for tuning in to Options Guide TV. See you at 11 a.m. Eastern Time for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.